watching Business Incorporated live from Channels HQ. Coming up, data out of South Africa shows that food prices continue to rise in the month of November. Plus, Moody's downgrades Ghana to further junk status, warns investors could lose in debt restructuring. Kenya says the country has no room for fresh borrowing. That's according to the Treasury. Thank you for joining us. I'm Ladi Williams. First off, let's take a look at how your money is performing at intraday, starting with Africa. Now, we see it's mostly positive sentiment on the African continent. We see South Africa there up 1.70%. Egypt also up 0.25%. And Kenya, we see it close negative. That was yesterday. Let's flip over now to the NGX and see what's happening at intraday. We have join us now Peter Abbey, equity trader, Stanbic IBTC Stockbrokers. Join us via Zoom. Great to have you on the program.
Thanks for having me. Good afternoon.
Good afternoon. So what's happening right now in the market? What's the sentiment like?
It's quite quiet. I mean, today, just 12 basis points. Market has gained 12 basis points, and the value at the moment is less than 600 million. That's just slightly above $1 million at the moment. What we've seen so far over the across the board, even in banks and consumer, is quite thin. I think we saw some interest early in the week, and which we feel people are slowing down a bit. I mean, if you look at what market has experienced lately, Sukuk bond just closed yesterday. So we feel so many investors will be concluding on rebalancing their portfolio and see how things go forward from here.
All right, what stocks are moving the market at this time?
Like I mentioned, it's quite thin. If I look at what is really the gainers and top gainers in the market today, they are just small cap names across board, the insurance, as well as a few banking names have gained today. So I'm not sure we will have that huge activity we saw earlier in the week today. Just less than 600 million traded so far.
And obviously, today is the last trading day for November. Where are you seeing the market? Maybe marginally up or down?
Well, if I look at how it has been trading so far, market just gained 12 basis points. So I feel we'll have it marginally up at the end of the trading session.
All right, we're watching out for that. Thank you so much. That was Peter Abbey, equity trader, Stanbic IBTC Stockbrokers. Thank you so much. All right, now, let's move on to the Middle East. We'll see sentiment in the Middle East is all positive right now at intraday. Moving away from what we've had, you know, normally in the Middle Eastern market, we've seen mostly negative performance at intraday, but today we're seeing all positive there in the Middle East. In the other parts we track there, we see Abu Dhabi up 0.58%, Dubai also up 0.69%. Other markets we track in the Middle East, talking about Saudi Arabia, that's up 0.18%, and the Qatari index up a big 1.07%. All right, let's move on now to Europe. Let's see what's happening there. We see Qatar and Germany now have an energy deal. The Gulf nation has agreed to supply Europe's biggest economy with liquefied natural gas as Berlin seeks to replace Russian energy flows. But the deal has sparked a mixed public reaction. Let's talk to Janelle Dumoulin now, right there in Berlin. What is the deal exactly, Janelle?
So we're going to be looking at 2 million tons of liquefied natural gas to be delivered annually from 2026, with this agreement set to last at least 15 years. The agreement between Qatar's state energy company and U.S. oil giant ConocoPhillips will see LNG delivered to Germany's northern Brunsbüttel terminal. Now, like we said at the jump, this is as Berlin wants to diversify energy supply away from Russia. But these volumes only only amount to about 3% of what Germany used to consume in 2021 before the war started. So this isn't exactly something that is going to be helpful immediately or send tremors through the world of liquefied natural gas markets, but it is considered a first step. However, there are a few interesting details about it. There was a lot of haggling over the length of the contract. Qatar wanted to lock in today's energy prices over a much longer time. They wanted 25 years. And they managed to also agree a similar agreement with China for a little bit over that, for 27 years. Germany managed to land in the middle with 15 years, showing that they are able to compromise with regard to the length of the contract, and that is why we have the deal that we have today.
And obviously, diversifying, energy sources is a good thing. Why the mixed reactions?
Well, because we're talking about Qatar. I remember last week we spoke about the World Cup and the fact that especially Western teams wanted to protest against the lack of rights for the LGBTQ community and against the human rights abuses documented among laborers trying to get the country ready for a tournament, There is a perception here that Germany is closing its eyes to these abuses and that it might not have learned its lesson in terms of doing business with or increasing dependency on countries that are not democracies. The lesson it's actually meant to have learned from having become energy dependent on Russia or being heavily invested in the Chinese market. Then there's a criticism about it being a long-term delivery deal of a fossil fuel. Environmentalists say that could be damaging for Germany's climate goals. They've maintained for a while now that what the government should not be doing is building what they call more climate-damaging infrastructure. So there's a lot in this deal that rubs many the wrong way, but the German government has decided that this is the way to go to help keep the lights on in the future.
All right, what's happening in European markets today?
Well, investors here are digesting inflation data from the Eurozone that shows some marginal slowing of price rises, although Christine Lagarde, chief of the European Central Bank, warned yesterday that this could not yet be considered a peak. The slowdown is mostly down to energy prices no longer climbing as fast as they have been. We're still very much in a cost of living crisis. Traders here are also waiting for the key policy speech by Federal Reserve Chief Jerome Powell later in the day that could give them clues as to the central bank's plan for tackling inflation in light of the fact that there is that slowdown that we mentioned earlier.
Madame Janelle de Malone there giving us the details from Berlin. Thank you so much, Janelle. Let's move on now to the UK. We have Juliana standing by right there. Great to have you again, Juliana. So the administrator to Joules, the collapsed fashion retailer, is on the brink of a rescue deal with the South African owner of Phase 8. Tell us more about this.
Yeah, that's absolutely right. This is a story, Laddie, that's been reported by Sky News about another embattled retailer, which is Joules. It's a pretty popular brand in the UK, I suppose, if you like clothes that are not exactly luxury, but not at Primark prices. They suffered post-pandemic. It was really difficult for them to get back the customers and the footfall into their stores. So they announced during the summer that they were looking for about £15 million to get itself out of administration. Didn't quite happen, so they did collapse into administration. I believe they have about 130 stores across the UK and about 1,600 staff. As soon as they did announce that they were in administration, a bidding war began, and that's between Next. Next are doing exceptionally well. They managed to buck the trend during the pandemic, and they are one of the biggest retailers here in the UK, as well as Mike Ashley. He is the owner of the Fraser Group. And then this last-minute bid, this frenzied bid, which we're thinking will be closed by the end of the day, has come in from the Fossakini Group, which is a South African firm, as you said. They own Phase 8, which again is a kind of low luxury store, as well as Hobbs and Whistles, which are also really popular here in the UK. And they obviously believe that Joules will fit in pretty well with the other departments and stores that they own. We don't yet know how much they're putting in. Again, Jules were looking for about £15 million during the summer. It's likely to be that kind of price. They want all of the intellectual property, so that includes all the online branding, the merchandise, as well as the stores. So it's seen as a good news. So this is being overseen by their UK arm, which is TFG UK. And according to Sky News, the British broadcaster, a deal could be closed by the end of the afternoon. So we'll have to wait and see if next M&S or the Fraser Group put in a counter offer.
All right, we're watching out for that deal there. But we got some snippets from the Bank of England there. The chief economist is saying that Brexit is partly to blame for the historically high inflation in the UK. How's this being received over there?
Well, we've got a lot of domestic issues at the moment, so I don't think Hugh Peel's statement has yet been picked up by Rishi Sunak, the Prime Minister, who's actually in the House of Commons chamber going through a pretty tough round of Prime Minister's questions today. But Hugh has been speaking to the Institute of Chartered Accountants, and he's been talking about, of course, the economy. Everybody's talking about the economy at the moment and some of the drivers for inflation. And he did mention that he does believe Brexit is a part of that, though I do have a little bit of his statement because sometimes the media can twist things. But so he did actually say that Brexit isn't the entire part of the story, but we do know that the labour market, for example, has been really struggling. It's been struggling because during the pandemic, lots of workers, European workers, they went back to Europe in the mainland and they decided not to come back because of the bureaucracy. And that is really pushing up the labour market because, of course, there are less people on the stores. Lots of people that are coming into work are demanding higher wages. And this is bringing up the cost of living here in the UK. There are also other contributing factors. Brexit is a very, very deep, long story. It's nothing you can kind of try and delve in a couple of minutes. But according to recent trade reports, we're seeing that exports out of the UK into Europe are falling. They are declining drastically, while exports within the mainland are climbing. We should be on par with our counterparts, such as Germany and France, and we're falling way back on that. Lots of the promises that were put to the British public before the referendum in 2016 have not become fruitful. We know that this is causing significant trouble on the island of Ireland, Stormont, which is the government is not sitting yet. The list goes on and on. I don't know if you want me to go into a full Brexit speech, Laddie, which I know you don't want me to do, but there are significant issues. And of course, this is affecting the UK cost of living crisis at the moment.
Right. So much to unpack there. But how are the markets looking at intraday?
Too much. Not bad, actually. The FTSE is in tip-top position, as you were just discussing with our German colleagues there. And we had the EU inflation data showing that inflation is declining, which is good news. Good news. Could that spell a decline in other parts of the world? We certainly need it just across the pond where we are, because it is really affecting people. We have that data from the British Retail Consortium showing that fresh food that you want to cook in your house is rising higher than it has any time on record. Not a great way to enter the Christmas season. But the FTSE is doing pretty well at intraday. It's up by 0.45%. The FTSE 100 is up too by 0.57%. And the FTSE 250 is up by 0.08%. In the currencies market, the British pound is still rallying against the US dollar. It's up by 0.43%. Also up against the euro by 0.11% and up against the Japanese yen at intraday by 0.54%, Laddie.
All right, thank you so much, Juliana. Talk to you tomorrow. Thank you.
Talk to you tomorrow. Thank you.
All right, now let's look at what's happening in other parts. Now, we see Asia-Pacific shares were mostly higher as the reading for China's November factory activity fell short of expectations, dropping to the lowest reading since April 2022. Talking about Asia, now Hong Kong's Hang Seng Index there briefly rose 2%. Final hour of trade, that's what's the trade that's happening in Asia. We see the tech index trading 2.66% higher, and the Shanghai Composite closed a little changed at 3,151 points, while the Shenzhen Component gained 0.176% to 11,108 points in Australia, while the S&P ASX 200 paired earlier losses and traded 0.43% higher after its monthly inflation indicator showed some slowing for October and closed at 7,284 points. The Nikkei 225 shed 0.21% to 27,968 points, and the Topix index slipped 0.37% to 1,985 points. All right, we'll take a break now. When we come back, more stories from the African continent. Do stay with us. This is Business Incorporated. Welcome back. Still watching Business Incorporated live on Channels Television. Let's flip over to U.S. markets now. See, stock futures rose today as Wall Street awaits a speech from Federal Reserve Chair Jerome Powell. Futures tied to the Dow Jones Industrial Average gained about 38 points to 0.14%. The S&P 500 futures and NASDAQ 100 futures also climbed about 0.13% and 0.25%. Well, for yesterday's close, now let's get a summary now from our correspondent, Maria Bird.
The U.S. stock market had a mixed day on Tuesday, as the S&P 500 and the NASDAQ had their third straight day in a row of closing lower. The NASDAQ closed at 0.59% down. The S&P 500 shed 0.16%. The Dow Jones was slightly up at 0.01% higher. Investors are a bit concerned about the lockdown in China and how that will impact the U.S. economy. They are also watching to see the announcement on Wednesday by the Federal Reserve Chairman. Will he increase interest rates before the end of the year? Additionally, they are watching to see the U.S. jobs reports and the economic tea leaves that might be released as a result of that and as a result of the earning reports by the end of the week. Many are watching to see how the fourth quarter will end and the U.S. stock market.
All right, thank you. That was Maria Bird there giving us yesterday's close. Let's move on now to the oil markets. The oil prices rose by over 2% today on signs of tighter supply, a weaker dollar, and optimism over Chinese demand recovery. But the likelihood that OPEC Plus will leave output unchanged at its upcoming meeting limited the gains. Brent crude futures rose about $2.23 to about 2.7% to $85.26 per barrel. The more active February Brent crude contract rose 2.4% to $85.29. US WTI crude futures climbed to $2.01 to $80.21. Support followed expectations of tighter crude supply. U.S. crude oil stocks dropped by 7.9 million barrels in the week ended November 25th, according to market sources citing American Petroleum Institute figures. And now to the metals market. Now see gold rose today as the dollar eased and was headed for its biggest monthly gain in more than 2 years, while investors embraced for a speech by U.S. Federal Reserve Chair Jerome Powell for hints on future interest rate rises. Spot gold rose 0.6% to $1,760 per ounce. The U.S. gold futures gained 0.7% to $1,759 per ounce. Gold is set for a 7.8% monthly rise, which would be its best since July 2020 and follows a 7-month-long lost streak. The Fed is largely expected to deliver a 50 basis point rate rise after 4 consecutive 75 basis points increases to tame inflation. A smaller increase could propel gold higher. And to other stories now, we see South Africa's latest household affordability index by the Petersburg Economic Justice and Dignity Group shows that food prices continue to rise in the month of November. The group's basket of nutritional foods for November came to 4,835 rand and 96 cents, up by 48 rand and 13 cents from 4,787 rand and 800 cents in October 2022. The year-on-year increase of 13 points, 2% outstrips headline inflation by quite a considerable margin, and even food inflation tracked by Statistics South Africa. Headline inflation was recorded at 7.6% in October, up marginally from 7.5% in September. Food and non-alcoholic beverages increased by 12% year-on-year and were on the key drivers behind the surprise increase in headline inflation. And South Africa's unreliable power supply and its high level of government debt are two of the main risks to its financial stability. The country's central bank made this statement, and Africa's most developed economy has seen 170 days of rolling blackouts this year due to a maintenance backlog of state utility Eskom's aging coal-fired power plants. The Reserve Bank has warned that the ongoing energy crisis, coupled with the high level of government debt amid a global economic slowdown, could affect businesses and manifest in a shock to the domestic financial system. All right, now let's look at the FTX contagion right now. That's still the conversation right now in the crypto industry. And joining us now is Peter Muren, Marketing Director at Yellow Card. Join us via Zoom. Can you hear me? Hello? Mr. Peter Muren, can you hear me? All right, looks like Mr. Peter cannot hear me right now. So let's move on to other stories now. We see in West Africa there, Moody's has downgraded the government's, the Ghanaian government's long-term issuer ratings to CA from CAA2 or further junk status, and changed the outlook to stable. This concludes the review for downgrade that was initiated on September 30th, 2022. Moody's expects that the restructuring of local and foreign currencies debts announced by the government on November 24, 2022 as part of its budget proposal for 2023 will likely result in significant losses for private creditors. And Kenya's National Treasury has doubled down on its efforts to swap the country's short-term debt with longer-term issuances, and this comes barely a week after it commenced a debt swap that will see a 7.8 billion shillings worth of short-term debt converted into long-term debt to ease the pressure on its experiencing from its maturities. Treasury Cabinet Secretary said that Kenya has little wiggle room for fresh borrowing, a situation that has been aggravated by the multiplicity of shocks to the economy, including the ongoing drought and effects of COVID-19 pandemic and the Russia-Ukraine war. All right, that's it on Business Incorporated. Thank you so much for watching. I'm Ladi Williams. Bye for now.